This is Dr. Chelsea. Dr. Chelsea owns 6 dental clinics and is looking to grow her practice by acquiring more. This is Dr. Brad. Dr. Brad owns 3 dental clinics that he is looking to sell. They're doing a total of $5 million in revenue. Dr. Brad owns both his business and his real estate and is looking to sell them both together for a total of $6 million. Dr. Chelsea only has $1.5 million and is considering taking out a bank loan of $4.5 million to complete the transaction. But what if Dr. Chelsea were to separate the business from the real estate? She could acquire the business, which is what she really wants, while simultaneously selling the real estate, which she doesn't need, to someone else, like Michael. The question is, what would Michael pay for this real estate? Real estate valuation is influenced heavily by the term of a lease and the quality of a tenant's credit. The longer the lease and the stronger the credit, the more money a seller can expect to receive for their real estate. Dr. Chelsea is willing to sign 15-year leases at $10,000 a month. This would make each asset worth roughly $1.5 million, or the 3 assets together worth a total of $4.5 million. So let's say Michael buys these buildings for $4.5 million. Dr. Chelsea would effectively be paying $1.5 million for the business. But why is this advantageous? What's important to remember is that the price Dr. Chelsea pays for her business is not necessarily what it's worth, and that by separating the business from the real estate while signing long-term leases, Dr. Chelsea is creating and unlocking value. Remember that the business is doing $5 million in revenue. At a simple valuation of 70% of revenue, the business by itself is worth about $3.5 million. When you compare this to the $1.5 million that Dr. Chelsea effectively paid, the difference of $2 million is the value that is created and unlocked with this transaction. Looking at it differently, if Michael values the real estate at $4.5 million and Dr. Chelsea's business is worth $3.5 million, there is a total of $8 million of value in the deal. When you compare this to the total cost, which is what Dr. Chelsea paid Dr. Brad, the $6 million, you can again see that $2 million is created and unlocked in this transaction that only Dr. Chelsea could receive because she is signing the long-term leases, not Dr. Brad. At the end of the day, Dr. Chelsea is happy with her business acquisition and the $2 million of value that she's created, all without incurring any additional bank debt. Michael is happy with his real estate investment, and Dr. Brad, who sold everything in order to retire, is taking a well-deserved vacation to Hawaii. If this transaction is interesting and you'd like to learn more, please reach out to the team at Alignment Realty Capital.